Good morning, everyone. Welcome back to that week 11. Today we're going to cover tax return for trust. Right? When we started the trust established whenever there's a separation of legal ownership from the beneficial and real ownership of an assets. Normally, the trust set up um, to minimize the tax, or as we said, separation of the legal ownership of the beneficial and real ownership of the assets. So I will explain through a simple example. So how that's trust going to be used to minimize the income tax. Assume that. So I'm going to share with you guys in our zero practice manager. I'm sure that you can see that zero practice manager now. And if you see the zero practice manager, you can see the Roy. So one of this client assume that he is running a small business, right? And assume that he is making a net profit of how much? Around $500,000. So his sales is 700. All of that his expenses assume that 200,000, right? So he's making $500,000 as a taxable income. If we're running as a sole trader business, this particular client going to pay the tax $215,000, five and $597. Please write down somewhere in your textbook or notebook. So if somebody running a sole trader business, and if they're making their profit or taxable income around $500,000, they're required to pay around $215, $597 dollar tax. Assume that now this Mr. Royce decided to set up a trust. Assume that a family trust. There are different type of trust. We assume the family trusts. So when we set up the family trust, we require to have three trust deed. What is the trust deed? The trust deed going to be set out all the terms and conditions of the trust. So it's mean who is going to be a trustee of that um, particular trust, who is going to be a beneficiary, and how it's going to be distributed, how we going to be trust managed. All the information will be in that document. That's called trust deed. So whenever do the tax return for the trust, we should have access to the trust deed to check that how we going to distribute that particular that income between beneficiaries, so that all the information will be contained in a document called trust deed. So that number one, so that Royce, what we can do when we set up the trust, he is going to put a trust deed, all the terms and conditions. So if you say in summary, the trust deed going to say who is going to be manage that particular trust. So we call them as a trustee. And second, who is going to be get the benefit from the trust? They call beneficiaries, right? Beneficiaries mean who is going to get the benefits from that particular trust. So when we talk about the trustee is going to be a person or a company, right? Trustee can be a individual person like you and me, or we can appoint a trustee as a company as well. So if you appointed a trustee as a company, we call them corporate trustee. If you appoint a normal person as a trustee, we call them trustee. So when we appointed the trustee in our trust deed, so all the business liabilities and that responsibility fall under trustee. So trustee have sole authority to operate and manage the business, right? So when we set up the trust, we going to set up a person called trustee to manage our business. He is liable to all the business transactions and debts and etc. So it's mean liability fall with the trustee. So now assume that Mr. Roy set up a family trust and set up the trust deed, and he appointed a person as a trustee, right? And in the trust deed, he put that his beneficiaries, his wife, and three children, right? Children number one, two, three. So how many beneficiaries in the trust now? Five beneficiaries, right? So he set out in the trust deed very clearly said, so this is a discriminatory trust. What he said that trust income can be distributed as per trustee's wish, right? Or you are giving that all the authority to trustee to distribute that income based on that his choice. So that's called discriminatory trust. It means trustee have the sole authority to distribute the amount between beneficiaries based on his calculation or based on his assessment. So now assume that this trustee distribute how much of total income from the trust business? $500,000 taxable income. Trustee decide to distribute this 500,000 between each the beneficiaries 100,000, 100,000, 100,000. So he equally divide into the five family members of 100, 100, 100. So now we how much Roy is going to get? Roy is going to get now only $100,000. So I'm just going to adjust this one. If it is $100,000, is Roy's received from that trust, how much the tax he required to pay? So we will go back to, and I will change this one to $200,000. So we maybe get it, no, we'll set it 300. I will get $100,000. So how much the tax Roy is required to pay? 26,717. Now I will go back to the little Excel worksheet and see how much the tax actually the whole family members going to pay. Right? All family members going to pay. So initial tax, Royce, how much that for the $500,000? How much the tax he required to pay? So we said the tax amount 215,597. 257,597. This is the one initially we assessed, right? So now assessed for 100,000, how much the tax is required to pay? 26,700 and 26,717, right? 770. So because he's only pay his tax. Assume that. So how many members that we distributed 100? Five members. All the five members, how much the total tax? Right? 26,000 times 5. So Roy's family going to pay all five members 100,000, 100,000, 100,000. So it's mean 26 times 5, which is 130,000, 133,585. 130,585. So how much the tax saving for the as a family? So how much the tax saving? 250,000 really Royce required to pay. But when he set up the trust and distribute between family members, they are paying $82,000 tax less, right? So most of the taxes set up to minimize the tax or to tax saving, same as how we discuss here. There are a number of other variables. At this point, I am not discussed. We will discuss down the track. So now we can see if Royce run a sole trader business and if he report to ATO his whole income, so he is required to pay $215,000. But if he Royce run a trust and distribute between all their family members, that's going to be reduce his total family tax 133 8 by 82,000, right? So this is the main purpose most of the trust setup. We call different name: family trust, discriminatory trust, fixed trust, hybrid trust, management trust, cash management trust. So there are different name we call, but most of the trust set up to minimize the tax or tax saving. right? So now we will come back. You can ask a question. So this amount which is distributed to that Roy's family members, actually we want to transfer the money to them or not, right? So that there are two questions: who is liable to pay the tax? Trust liable to pay the tax, or family members individually liable to pay the tax? So normal rule that the individual beneficiaries, they are liable to pay their taxes. So so the wife should pay through their income tax assessment. So how much is from the trust income she should pay? Each children should be pay the tax, pay whatever amount they receive from that particular trust. So trust income, normal rule or general rule, the beneficiaries are liable for the particular tax amount. So 26,717 each family member going to pay, right? However, so it's not necessary trust distribute that actual money into that beneficiaries. So what I'm trying to say here, for an example, Royce can say, yep, this is the declaration, this much is the distribution to the each family members, but not necessary to actually transfer the money to that bank account of that kids or that wife, right? But even not transfer the money to their bank account, that each individual beneficiaries are liable for their income tax, right? So if they not transfer to their personal bank account, it will show in a trust balance sheet as a beneficiaries contribution or beneficiaries fund, as a, so normally we call equity, but in trust we never call equity. We can say beneficiaries fund, and each beneficiary's name account will be so as a how much we want to pay to them, right? But regardless of you that beneficiary receive the money or not, they require to pay the income tax, right? So now we cleared that there are two things: that who is going to pay the income tax regardless of they receive the money or not. So now I will go back to that in our presentation or PowerPoint. So we all know that trustee is a legal title. So trustee under the terms of trust instrument we call trust deed, right? That the what the power trustee getting from trust deed, right? That's called trust instrument here. Trustee may be a natural person or company. So if you want to do your business, should you have a limited liability, you may be go with that company as a trustee. If you not worry about that legal liability or limited liability, you may go as a normal person. You all knows that, but the limited liability concept, if you are, for an example, if you lost that in your business, if you have some claim or losses, that can be only offset again company assets, right? If you're running as a sole trader or partnership, if you make a loss from that your business, or if you make a significant debt from that business, if you can't pay through that partnership or sole trader business, you are that when that you may lose that your personal assets such as house and cars and all the assets as well. That's called unlimited liability. The limited liability mean company is a limited liability. For example, company make a loss $2 million, the assets only 1 million. Whoever administrator come in, they will sold that assets and settle that from the company assets. If they can't settle further to company assets, they cannot ask from the director or shareholders, right? The shareholders and directors personal assets are protected. So it's mean limited liability only for company assets. So when you're running some risky business such as cleaning business, or you're running a medical practices, you may think that sometime higher risk. A person may be fall on and say, hey, I want the $2 million compensation because you did not put that proper board when you are doing the cleaning, or you did not give the hazard directions, or that some medical practices when the clients can file $10 million compensation. So this type of incident, you don't need, if you don't want to lose your personal assets, what we going to do, we going to put that company as a trustee. In that case, whatever happened, maximum you going to lose company assets. Your house, in your car, in your other assets will be very safe, right? So that's the reason we set up the company as a trustee. But small businesses, normally they do the natural person. So when you set up the trust, it is not necessary only for business, right? You can set up the trust for the property as well. For example, you have a $5 million, whatever $1 million property in the middle of that city. If you want to rent it out, you can set up that particular property as a trust. In that case, whatever income come from the trust through the capital gain or through the rental income can be distributed between beneficiaries, or you have shares in that share market, or you have the other financial instruments, you can use a trust to distribute that one, right? So now we will come back to beneficiaries. Beneficiaries may be a natural person or any other entity. So what are the natural person? Maybe a resident or non-resident or minor or anyone, any human can be listed as a beneficiary. But tax consequences may be different. I will talk with you in a couple of minutes time, right? So I will talk with you in a couple of minutes time. At this stage, you assume that any person can be appointed as a, or that notified as a beneficiary, right? So, and any entities also can listed as a beneficiaries. For an example, a partnership, or a other trust will be a beneficiary of one trust, or a company. So entities also can be a beneficiary. Resident or non-resident can be a beneficiary. So the beneficiaries, what they are doing, they are going to receive that income from the trust. They are not owners of the property, right? So they are not a owners of the property, but they are entitled to receive that benefit from trust net income. Trust net income. However, whenever trust make a loss, we call tax loss, that loss cannot be transferred to beneficiaries, or trust loss normally not distributed to beneficiaries. Trust will carry forward the loss and offset again trust income in the future. This is the main difference between partnership and trust. The partnership, that regardless of you are making profit or loss, it should be distributed to the partners. For example, $20,000 loss from the partnership, two partners 50-50, you're going to distribute $10,000 loss each of them. But if trust making a loss of 20,000, that loss cannot be distributed to beneficiaries. That will be carried forward in the trust income tax return as a tax loss. In the future, if you receive any income or net profit, that will be offset again to that particular tax loss, right? That's a beneficiaries not receive any tax losses. Beneficiaries are not owners of the business, right? So for an example, a discriminatory trust, trustee can decide who he want to give the money. So a couple of beneficiaries, he may say, I'm not going to distribute anything to them. So we'll come back to that in a minute, right? The beneficiary does not have to be a person. I said very clearly, trust income must be legally available distribution to the beneficiaries. So I said that anyone can be distributed as a person. However, there are some different tax rate for the group of people. We call legal disability exist where a beneficiary. So now we want to understand, if a group of people in our tax administration act or in our tax guidelines say, if you provide to this group of people, if you provide the benefit to this group of that taxpayers, right, We call them legal disability exist beneficiaries, and you required to pay higher tax, and tax should be paid by trustee, not by beneficiaries, right? But you can put them as a beneficiary, there's no restriction, but they not required, they not expected to pay, they are not obligation to pay the tax. So who is going to apply to pay the tax? Trustee. So now we will see who are these legal disabled exist where is a beneficiary, right? Number one, minor, anyone under 18. Normally we consider them as a, no matter they are not disability, right? The legal disability for tax purpose, tax beneficiary purpose. So if you allocated to that benefit to that under 18, right, who is required to pay the tax? Trustee required to pay the tax, not to that minor. No need to worry about that because he come under legal disability. So, and the minus tax rate are very expensive. I think a couple of slides later we will discuss. Anyhow, the first $416 minus not going to pay any tax. 416 to $1,307, they pay 66 percentage between that area, the bracket. Then anything over $1,307, they're going to pay 45 percentage. It's very expensive. So that if it is something come under the legal disability, who is going to pay the tax? Trustee is going to pay the tax. What is the percentage he is going to pay? Very 45 percentage, above 1,307. Therefore, you can see in the real world, people not allocate for that minus. Why? They are paying very higher tax, right? They have no bracket, so it's no worth for that to allocate to them, right? But you can allocate 416. That's no need to pay the tax. And the second part of that one, so if you undischarged bankrupt, what's mean? Currently if you are under the bankruptcy, right? So you may be a 7 years or 5 years or 3 years, depending on the bankruptcy type. If you are undischarged bankrupt, if the trustee allocated to that income to you as a beneficiary, the trustee is liable to pay the higher tax rate of 45 percentage, same as any someone declared as a legally incapable because of the mental condition. So somebody cannot take the decisions on behalf of them because of the mental conditions, they will become under legal disability. If you provide that income to them or if you distributed the income to them, you're going to pay that 45 percentage. And who is going to pay? Trustee going to pay. Another one, if a person serving 3 years or more prison sentence, if you allocate it to them, they come under the legal disability and trustee is going to pay 45 percentage. Sometime in the trust deed, clearly maybe exclude some person. For example, Royce can put it, Mr. X should not be distribute any single distribution. He want to exclude some of that person in that trust, right? Clearly they are, should not provide. But if trustee went and provide that distributor to that excluded person, right? In that case, trustee liable to pay the tax, right? Trustee liable to pay the tax. This is called legal disability exist where a beneficiary under this category. So they may be a beneficiaries, not issue, but they're required to pay the tax on that, right? Who's going to pay the tax? Trustee going to pay the tax. For an example, we have $500,000 total taxable income. Trustee decided to only 480 distribute between beneficiaries. In that case, that undistributed balance 20,000, trustee liable to pay the tax, right? Who is liable to pay the tax? Trustee. What is the percentage? 45 percentage. So the trustee, when he's going to pay the tax in the two incident, one the legal disability whereas exist for the beneficiary as listed that five circumstances, Or if trustee not distribute all of the amount, is a undistributed component will be trustee required to pay the tax, right? So this the beneficiaries and trustee, so we understand. Now we will move into type of trust. There are different type of trust available for with the different reason. So we will see one by one. One called very famous one, discriminatory trust. Discriminatory trust mean the trustee has the power to determine how much he want to distribute between beneficiaries. It's very clearly say in the top of the trust deed, this is a discriminatory trust. If it's a discriminatory trust, who is going to determine how much going to give to that each taxpayers? The trustee going to decide. This is one of the famous one. What is the main reason for this? The trustee can adjust the distribution to maximize the tax benefit or tax savings. So I will show you one example through that Excel, then we will work on that. All right, it's a very basic, we have so many other factors must be considered. So I'm going to put it that uh, 5 beneficiaries: beneficiary 1, beneficiary 2, husband, wife, children 1, children 2, children 3, right? So assume that we have 500,000 to be distributed. So normally what we did previously, we divide by 5 and allocate them 100, easy, right? However, assume that, so Roy is not working anything, zero, he's working for trust, or that he's working for trust and receiving $45,000, right, from the trust as a salary. And his wife not working, and is one of the child working for 75,000, is working as accountant, right? And other two kids not working, right? So the last kid's working $20,000 he's getting from Centrelink or whatever, right? Assume that like that. So in this scenario, normally we not divide by 100 and give it to them to maximize that one. So what normally do we identify in the family? What is that highest taxable income? What is the highest taxable income? 75,000. So assume that everybody will get it 75,000, right? Everybody get it 75,000. So I'll put it here 75, right, and make it here everybody going to get it 75,000, right? It is like a little formulas, right? So now if you make it 75,000, this guy, how much you want to trust to distribute? 35,000. So 35,000 plus this 75, right? So how we got it this 75? I will put it this one minus this, right? F4. No, sorry, my apology. Other way around. 75 minus this. If you added this to 75,000. So if first step, you're going to make it everyone same income. So we will see how much it is. So you allocated this guy who have no any income, 75, 70, other one 75, right? And we'll go and see here, 75, then this guy also 75. So everybody now in a equal stage, right? So what we did that, we adjusted everyone to make it that highest income in that other accessible income. Why we are doing? To make it more effective in our distribution. So out of 500,000, how much we distributed now? If I add this one all, 235,000 already we distributed. So how much the balance we have now? 500 minus 235, we have 265,000. So now we going to say equally to every individuals, right? Equally every individual. So I will track this one, right? So how much the total distribution now? Your distribution 30, second distribution 53. So your total distribution, you can say discriminatory, right? The different amount trustee going to distribute between that beneficiaries to make it that everyone equally pay the tax, right? That's the best way sometime, not all the time. Now we will say each one how much that their income, 83,000 from the trust, other income 45,000. So everybody get it 128, right? 128. So that's called trust distribution. So how much the total trust distribution? 183, 128, right? So this other income will be changed every year, maybe go up and down. To adjust this one, trustee should, we cannot change the trust deed every year, right? That's very little bit harder. So if you keep it the trust, same trust deed, and make it that your distribution different based on your other assessable income, so the trustee should have a power to determine how much I am going to give to the each beneficiary, right? So you can see that amount is varied. This is called discriminatory trust. It means trustee have the power to determine how much you want to distribute, right? Why we are doing this all? To get it more benefit from in our income tax brackets, right? When you do the tax return, you can understand why we are doing like this. I just only include the other assessable income. We can consider some other matters, how much the income, how much the deductions, how much the tax losses, how much the Medicare surcharge, are they have the private health insurance, how many children's, are they have the prior that student loan or health loan. So all these things should be considered to determine how much we are going to distribute to that one to minimize overall tax, right? Overall total tax. That's called discriminatory trust. You're going to use that more flexible to determine so each members how much to get it. I just explained very basic one through the other income, but there, as I said, you're going to consider how much the deduction, previous tax loss, previous any other capital gain this year, and you're going to consider that they have the Medicare or not, so they have that private health insurance or not, they have the study loan or not. All this stuff will be considered before distributing. So trustee going to decide how much they're going to allocate. That's called discriminatory trust. That's called discriminatory trust. Now I will come back to that our original screen. So we'll explain a little bit more, right? So the discriminatory trust have three parts. The trading trust, if you involve with the buying and selling, that will be a trading trust. If you provide that management consultancy or any management related or services, normally come as a service discriminatory trust. If you involve with that any kind of investment in a property or in the shares in a finance, we call that discriminatory trust investment in the dash, right? Fixed trust. So when we write the deed, if the trust beneficiaries are fixed, for example, if they say 25% to the husband, 25% to the wife, and balance 50% will be to distributed between two children's, 25, 25. So it's mean it's a fixed trust. The trustee have no any say on that how much distributed. This is called fixed trust. Still trustee, you're going to distribute, but trustee doesn't have authority to determine. Only he determine how much the total amount, 500,000. What is that first beneficiary getting? 12.5 percentage. He multiple by 12.5 will give it. If it's the second beneficiary 25 percentage, he will multiple 25 percentage time total income, and that will go to that trust. That's called fixed trust. Unit trust. When you set up the trust, or then in the trust deed, it will be identified each beneficiaries how much the units they are going to hold. Or assume that 1,000 units they set up in a trust, and 500 units to husband, 500 unit to wife, 300 unit to husband, and 100 unit to first child, and second child 100 unit. So you have the proper that you have the proportion in your proportion of that unit what you hold, you will get it your benefits. So almost a fixed trust. But the benefit of the unit trust, you could exchange between your beneficiaries. For example, when one beneficiary, they don't want to keep it this trust, they can sell it to other beneficiary. So the one beneficiary, what is the end of the financial year, each beneficiary, how much units they hold, based on that, trustee is going to distribute that trust income to the beneficiaries. That's called trust, unit trust. Almost like a shares, but we call it, that's the business setup is trust. Therefore, we call unit trust, right? Unit trust mean you have a that particular amount, that amount of units. So you can say 1,000 units. The trust deed will tell us how we can sell it, how you can buy. Some trust deed will very clearly say only you can sell it the units between the family members. You cannot sell it outside of the family. So in that case, the restricted unit trust. If it is say you can sell it to anyone, it's open unit trust to anyone, right? Family trust. So this is very famous. Most of us, we think that the family trust is the trust which is set up for husband and wife and children, the immediate family members. Not necessary. It's set up to that extended family members as well. When you see that most of the trust deeds, you cannot see the name. Only the trust deed going to say wife or husband, father-in-law, mother-in-law, father, mother, brother, sister, sister-in-law, brother-in-law, right? And children's and grandchildren and grand-grandchildren's, like that. Only you can see in the family trust, the beneficiaries are listed with the relationship or biological relationship, son and daughter and everything. The reason is because whenever your relationship broken between your husband and wife, that why if you mention that name, as per the trust deed, still she may be eligible to get the benefits. This is the reason they just put it as a wife. What is the benefit of that one? So if they somebody change their family relationship, the new person come as a wife or husband, she will be getting the trust beneficiary, but previous person who divorced or he separated, she will not eligible to that. So most of the family trust set up with that actual relationship names, not to that individual names inside, not in that family trust, right? But some family trust, yes, individuals names also there. So it's depend on that the families and their preferences. Most of the family trust are 90% of the family trust are come with the relationship, like a father, mother, grandchild, and children's and son and daughter, right? So it's not necessarily only immediate family members, that can be extended beneficiaries, extended family members as well. Cash management trust, if a group of investors join together and set up a trust to invest on the property or some investment funds, that's called cash management trust. And public unit trust. Public unit trust mean 50 or more people beneficiary should be included, and 20 or less people should not hold more than 75 percentage of the unit, right? This is a unit trust. So the unit will be available sometime in the stock exchange. You can buy through the stock exchange. If you listed in your stock exchange, we call listed public unit. What's the meaning? It's a public trust. Anyone can buy that unit. It is available in the stock exchange. If it is available in the stock exchange, that's called public unit trust, right? Still, it is the trust, not the company, not the shares, but you can buy the units in the say stock exchange. If it is not listed in the stock exchange, still if you can buy that unit from that normal other medium, that's called non-listed public units. It's mean that's not available through the stock exchange, but still available to public to buy from directly from that particular trust. That's called the public unit trust, listed and non-listed. So 50 or more per person should have a beneficiary, and where 20 or fewer person hold 75% or more beneficial interest, the income property of the trust. This means you cannot have more than 75 percentage together at 20 people, right? They leaving the control. Management investment trust, if you involve with that any passive income business activity, for an example, a rental income or interest income, or dividend income. So invest on the real property, or invest on the shares, or invest on the financial market. We call that type of trust managed investment trust, right? Charitable trust. So if any charity purpose you set up the trust, that's a charitable trust. Special disability trust. Special disability trust mean in a family member who is under the part 3 of 18A Social Security Act 1999, if he says, if he declared as a disabled, the family members can join together and set up their trust to care that particular disabled person in that family, that have some special offsets and tax rates. That's called special disability trust. Deceased trust mean, so person when he passed away or died, so that somebody should be signing their tax return, right? That's called deceased estate tax trust. Deceased estate mean, so you act on behalf of person who passed away or died, right? So most of the time the husband or wife, one no other died, so that other person will come as a deceased state. However, they should come with that court's order, who is the trustee for that other person. We normally, when we prepare the tax return, we call executor. Executor mean who are the person under the deceased estate trust, right? To allow that authority to declare the income and expenses on behalf of the person who died, right? Other one, testamentary trust. So whenever we have a whenever we have a will, we can include who is the trustee to manage all of the assets and obligations of the that particular person who's writing the will. That's called testamentary trust. That's called testamentary trust. So whenever the person passed away, so they will take the will and write down all the stuff, right, that they implement. Whoever trustee in that will, he will implement the trust. That's called, it's mean he will sell that all the assets and sort out that obligation, or as per whatever said in the will, he will act on behalf of that person who wrote that will, right? So that's called type of different trust. Now we will come back, prepare the trust tax return. There are very clear guidelines how to do that. So you can click these links and it will be provide you that full instruction how to do the trust tax return. However, I am going to share with you in a minute some of the important points. So you can see there are a number of sections in the trust tax return, especially that business income and expenses, same as what you did for in our partnership. I will explain through the XPM in a minute. Then you're going to put that any tax withhold amount through the ABN not quoted, or from the foreign resident withholding. That's the one in number 6. Then because trust not going to normally not going to pay the tax unless that they are allocated to the disabled beneficiaries. Disabled mean legal disability beneficiaries. Credit interest from the ATO will be number 7. Any partnership and trust income. What is the meaning? Any partnership and trust income mean this particular trust may be a partner of that a partnership, or this particular trust may be a beneficiary of the other trust. When they receive the partnership distribution or share of the trust income from that other trust, it will come in the number 8. And then anything that rent. So if that particular trust owns some assets and receive that rental income, same rental schedule what you guys did that previously for individual, you're going to do for the trust, that'll come in number 9. And the foreign investment, that for forestry management investment scheme, I not involved here. And cross interest, if the trust have some savings in the bank, if you receive that interest, that will be listed under the 11. And if the trust have some shares in other company, right, so and when we receive the dividends, it will fall under number 12. And superannuation, the death benefit of the termination, employment termination payment, and superannuation lump sum payment received for a trust, that will be fall under 13. Any other income will be fall here. So all will be together. That is your taxable income. So now we will go back and see how we going to do actual trust tax return through the XPM. So I'm going to create, I'm going to create, I'm going to create a trust tax return in a minute. All right. So client, so it's going to be a trust. So we will say Royce Family Trust. All right. And you can fill it out all the details later and put the premier tax and bookkeeping, and we'll put it the date here and create. Step number one, what you're going to do, you're going to put that the beneficiary, right, at the relationship. That's very important because easy for you to later. So you find it out the person, right? So it's the Steve Smith or Smith Steve or whatever, right? So it's the beneficiary. Also, you're going to add the trustee, right? So trustee may be an individual or company. I will put the same person to is it right, Steve Smith? Right, right. So we add it. So it may be a different person. It's not necessarily same, right? But the beneficiaries will be listed 5 or 6 or 10 or 20 as per that your trust deed. So this each beneficiaries you must have. What is the tax file number? What is their date of birth, address, full name, and their email address and phone number. In addition to that, you must have the identity as well, right? So you must keep it. They are either like a for license or their passport. So this all the stuff you must do before add them as a beneficiary, right? That's called beneficiaries creation. So now we will create a tax return for the trust. So the trust tax return will be normally we call TRT, tax trust tax return. If the partnership PTR, if the company CTR, if the individual ITR. So TRT and click 2020 tax returns. We did here, right? And now we will go to the cover page and said most of the informations are same, anything not important. You important, but you already discussed this stuff with that one. All right. So now we'll come back to this point, the full name of the trustee, because he is the person going to pay the tax. So if you can see Rusty source, you can say manual or coming from that your link. So here saying that trustee, you say individual or non-individual, that question should be answered. If they say yes, non-individual, you are going to put the company name. If you are in no individual like you and me, you are going to be no. It's non-individual answer is no. It's mean individual, right? So if the non-individual yes mean, that will be a corporate trustee. You can see ABN number come up, right? If you say no, no ABN number, only the individual person. So and can go down the family trust election. It means if you change anything in your deed, you're going to include any beneficiaries or some beneficiaries benefit. You're going to say you did that which year, and you remove or add or vary it, it's here. If you add any company or company's beneficiaries entitlement, you're going to say company or partnership or trust. We use under the interpost family, interpost entity election status, right? So that's one will be. So the full detail of this one you can see from that in the link. Now, type of trust, we already talk about the different type of trust. You can see all the trust will be here. I think I did not talk about the hybrid trust. What the hybrid trust mean? You have the fixed component and discriminatory component. For an example, in the trust deed, say 25 percentage, 10 percentage to the first child, second child 10 percentage, third child 15 percentage. So it's fixed. The balance will be distributed between husband and wife. So the trustee have some fixed component and have some discriminatory to say how much to wife and how much to husband. That's called hybrid trust, right? That's called hybrid trust. So you can work it out. That's which one in that category. So the discriminatory have trading or investment or service. I already explained to you guys. So fixed trust and public trust and not listed and listed. So we all know that what is the trust setup. So you can click here and put that whatever your trust, right? So I'll put the service trust. So then it's a charitable or not. We will say no and go back to that here. Management investment trust is mean it's anything passive income related trust. You can say management investment trust, which mean invest in the property or invest in the shares or invest in the finance market. It will come up and you're going to say what kind of trust. Then it's the question will come up, is any amount payable by trustee? When trustee is going to pay the tax, that's the circumstances one. If that beneficiary come under legal disability category, such as minor or that prison sentence, whoever prison 3 years or more, sorry, the who got that sentence 3 years or more and currently serving in the prisoner, or bankrupt, or incapacitated mental conditions person, or that excluded person provided by trustee. That in that case you want to say yes, right? If you the next question, or if you are not distributed all of your trust income that trustee is liable to pay, you can say. So then final tax return. If you close the trust this year, you're going to deregister, you decide to deregister your business, you can say this is my final tax return. Or a deceased person who died, there may be a final tax return, right? So then rest of the stuff you know that same as previous. Income section number 5, as we explained previously, everything same as that partnership or sole trader income. Any other expenses you're going to include here, all of your income you're going to do that. And if you want to keep it the financial report differently from same as tax return, you can do that adjustment or reconciliation here. Then I explained to you the partnership very clearly, and interest come from ATO. If you paid something more or amendment, that maybe make some interest back, that will be here. And partnership and trust same, and rental I explained to you guys. I did not explain this one. We were not more into much involved with that at this point. Cross interest I explained from that, including Australian government loan interest is a income, right? And dividends and superannuation and other income. So when you finish it, that one, we're not going to involve with any of the deduction because you cover under the business income tax and expenses. So deduction will come up under 5. So when you finalize, you go to the beneficiaries and going to distribute to them. If you listed 5 beneficiaries, everything will be here. So now we'll one beneficiary, I will explain to you how it's at work. So you can go and see how much they did not put that income. So first we'll put it some income for this guy, say 500,000 total taxable income, 500,000. So that 500,000 can be distributed. Click on the beneficiary. The first beneficiary, you have a question here, what distribution type? You are going to percentage mean, if you put the 10 percentage or whatever percentage, that will be taken out from 10 percentage of this. For an example, I put the 10 percentage, right? You can see here 50,000 will take it out. If you say no, I'm going to do through the manual, so because that discriminatory trust, you can say all right, I want to go 75 or whatever. Manually you can do, right? So manually you can type that. Oops, 1 second guys. You can see in this side the balance will show. So when you go to the next person, this 420 will come up. So you go into one by one, put the finally this amount should be 0. In that case, you allocated everything to your your beneficiaries, right? So when you that there are 3 percentage manual, and last person will get maybe balance of income that depend on the deed. So now we will come back. So here you're going to say what kind of beneficiary he is. I talk about that. Legally disability category mean you're going to put he is legally disabled. Not under legally disabled mean you're going to put that not under legal disability. So as we discuss everything's here, you're going to click more appropriate one based on the client, right? Based on the beneficiary. Then you finalize the tax return. So whenever you finalize the tax return as a registered tax agent liability, you must advise to each beneficiaries how much their distribution from this trust. Not necessary to other beneficiaries detail, not necessary to disclose, but you can say how much the benefit distributed from this trust to them. So because that they may be not aware, or they may have some issue in the down the track with the trustee. So you may be advised to them, number one. Number two, you must make sure that all the beneficiaries are, that you identified the right person through their driving license, or in their passport or relevant identity documents, as well as you have their tax file number and date of birth and all the information required to uh, um, uh, as the beneficiaries, right? So now we, in this week, we put that the trust tax returns you could enjoy, and the answers will be available most probably a couple of days from today, right? So good luck with your trust tax returns, and then we will move into the company next week. So thank you everyone, and as I said, this is the tax rate. We talk about these topics very clearly. When you distribute the tax trust income, you're going to discuss about the other source of income, your progressive tax implications and tax losses, Medicare and health repayments and all the stuff. That's when you do that exercise, you can understand how you're going to do that one. So now we are going to finish today, and thank you very much, and looking forward to see you next week.